Good afternoon. Good afternoon, everybody.
Good afternoon, sir.
Okay, thank you very much. Let us start today about interest rate risk. You know what is interest rate? So normally the rate is paid on loan, borrowed loan, or any deposit. So in the bank's point of view, interest rate on deposit is a cost of fund cost. The interest rate on loan provided to its customer is kind of income, right? So that's the main income. So when to understand better, we can move uh, to the next slide where we can find uh, income statement of finance company, right? So here it's a, typical income statement of a bank, right? It's a bank. And when we look at here, it starts from interest income. When you look at manufacturing or non-finance company, you may find revenue. And second line, you may find cost of sales. Since it's a bank, it's a finance company, here the major income is interest income, right? Interest income, and major expense is interest expense. So difference between interest income and interest expense is a net interest income. Net interest income. So the net interest income varies due to changes in interest rate. When interest rate increases, if they have more loan to its customer, they may increase this interest income. And also this portion is paid on deposit, so it's expenses. So the changes in interest rate may impact directly on this net interest income. Net interest income. So the changes in interest rate ultimately impact on net interest income of any financial institutions. In addition to the net interest income, the bank may have other source of income, right? Now we move to the session. So interest rate in risk. Interest rate risk refers to volatility, the fluctuations, refers to the volatility in net interest income or variation in net interest margin. So it focuses on this, right? Net interest income. Therefore, an effective risk management process of any financial institutions that maintain interest rate risk within a prudent level is essential to satisfy the safety and soundness of the bank. So if the bank fails to maintain this gap between interest income and interest expenses, if it fails to maintain this gap net income net interest income, the bank may uh, bankrupt, unable to survive in the market. The bank performance is influenced by the interest payment earned relative to interest paid. So the bank performance is influenced by interest payment earned. So it's this interest payment earned typically from the loan provided to its customers relative to interest paid. It's the interest paid on deposits of its customers. Here net interest margin equal interest revenue, interest income minus interest expenses. So interest revenue minus interest expenses equal net interest income. It should be divided by assets, total assets. Then you can find, you can get the net interest margin. So during a period of raising interest rate, bank's net interest margin will likely decrease if its liabilities are more rate sensitive than assets. So think about, when interest rate increases, the bank's net interest margin will likely decrease. How it is possible? How? So this is expenses, this is revenue. Uh, when interest increases in the market, so both should increase, no? Both should increase. Interest revenue also increase. Both interest expense also increase. But here it says, during a period of raising interest rate, a bank net interest margin will likely decrease if its liabilities are more rate sensitive than its assets, right? So this is what this interest expenses paid on its deposits. So this revenue generated from the loan provided to the customers. So normally the loan provided to its customers are long term. Long term in 10 years loan, 5 years loan, 3 years loan, 1 year loan, like that. So long term, normally the interest rate is fixed. Interest rate is fixed. But in the point of view of depositors, normally they deposit. A major part is unstable deposits. Unstable deposit. So these deposits are more sensitive on interest rate. When interest rate increases in the market, many people expect high interest rate on its deposits in the bank. So that time, the bank has to pay more interest than earlier. Meanwhile, that interest rate increases may not impact on this revenue since it's fixed. So due to this mismatch, and the deposits are more rate sensitive, so this is the reason for this decrease. So during a period of raising interest rate, a bank's net interest margin will likely decrease if its liabilities are more rate sensitive than its assets. You know that deposits are more rate sensitive than its assets, than its loan. During a period of decreasing interest rate, in the market, uh, the interest rate is decreases. Here it's normally a fixed one, and this is now going to reduce. Now the gap between these two will rise. So during the period of decreasing interest rate, bank's net interest income margin will likely increase if its liabilities are more rate sensitive than its assets. The same way. So when you look at these diagrams, both these diagrams, you can understand the things. So you see, the red one are the rate on loans, assets. A loan normally assets, and the blue line represent the cost of fund, the interest rate paid on deposits. So during the increasing interest rate, here the rate on loans a little stable, but the cost of fund, the rate on deposits, more sensitive. No, when the time passes, when interest rate increases, it fluctuates much. So the gap between the loan rate and the deposit rates are reduced. So here high risk, there has high risk. The margin is going narrow. In case of decreasing interest rate, here the loan rate almost the fixed one, and it does not much fluctuate due to changes in interest rate, but the deposit rate. So the banks can earn more profit during the period of decreasing interest rate, because here the deposits are the liabilities, especially interest rate sensitive is much. And so what are the methods, what are the ways to assess interest rate risk? How can assess interest rate risk? So what are the methods available? The first method is gap analysis. Second method is duration analysis. The third method is regression analysis. Gap analysis, duration analysis, and regression analysis. Gap analysis, more importantly, they are it care about uh, interest rate sensitivity of assets and interest loans and deposits. Now we'll move on the gap analysis in much detail. So gap is defined as, here the gap equal a rate sensitive assets. Rate sensitive asset, for example, loan, especially a short-term loan. Short-term loan, with the long-term loan, normally the interest rate is fixed. Fixed if fixed at 10%, until its maturity of the loan, its interest rate is 10%. 10 years loan at 10%. It not varies. The interest rate is not varies over the 10 years. So that long-term loan, that especially fixed one, is not rate sensitive assets. And rate sensitive liabilities, so it includes uh, unstable deposits, not fixed deposits. Fixed deposits, for example, more than 1 year, that's not much rate sensitive. So when at the time of deposit, fixed deposit, so they already decided the deposit rate, interest rate of on that deposit, fixed deposit. So any changes in the market on interest rate will not impact on long term or fixed interest rates, long term loan or long term deposits. Especially here it focus on short term loan, especially bank overdraft, short term loan, and short term interest, the saving account, not fixed deposit, savings. So the rate sensitive assets minus rate sensitive liabilities. The gap ratio. So the gap simply rate sensitive minus, here we put minus, and rate sensitive liabilities. So rate sensitive ratio is mean rate sensitive assets divided by rate sensitive liabilities. Here we have to put division mark, not minus, in case of the gap ratio. The gap ratio is the volume of rate sensitive assets divided by rate sensitive liabilities. For example, a bank interest revenue, a bank generated interest revenue of 100 million last year, and 45 million interest rate expenses. Now, how much net interest income? Any answers? Net interest income, how much? How much net interest income? My dear students, yes, 55,000. Very good. Very good. 55,000. Right? How we get 100 million minus 45 million equal 55 million. That is net interest income. So that is the figure taken from income statement. When we look at the balance sheet, the bank has 2 billion assets. Totally, it has 2 billion assets, of which 800 millions are rate sensitive. So it's a short-term loan. 800 millions are short-term loan. The rest 1.2 million, 1.2 million, not 1.2 billion assets include non-rate sensitive assets. Now we want what? Rate sensitive assets, especially short-term loan. And the bank also has 700 million interest rate sensitive liabilities, especially deposits, short-term deposit. What are the Philly Bank's gap? The name of the bank is Philly. Philly Bank's gap and the gap ratio. It's very simple. It is very straightforward. So you can take rate sensitive assets is equal to 800 million minus rate sensitive liabilities 700 million. So therefore the gap is 100 million. Gap is 100 million. It's a positive. It's a positive gap. So when we look at the gap ratio, it's simply 800 million minus, so divided by 700 million. So it's equal simply 114.29. If the gap is positive, it's more than 100%. If the gap is, the ratio is negative, the gap is negative, then gap ratio will be less than 100. So maturity gap method, interest rate, right? Maturity mean what? The time band. So some assets, some loans is mature in 6 months, 3 months, 9 months, 1 year. A long-term loan mature 5 years, 2 years, 10 years, especially more than 1 year. Right. So there are 3 options based on the maturity of rate sensitive assets. So there are 3 alternatives. The first one is positive gap. So when it's a positive gap, so in the early example, I told you this one is a positive gap. Why? The rate sensitive asset is higher than rate sensitive liabilities. Here, the rate sensitive asset is higher than, is larger than, greater than rate sensitive liabilities. So that time we call as positive gap. And the rate sensitive assets is less than, rate sensitive liabilities. Now we call it a negative gap. Negative gap means what? The short-term loans is less than the short-term deposits. Rate sensitive assets equal to rate sensitive liabilities equal 0 gap. So these gaps, the gaps between short-term assets and short-term liabilities is very important to analyze the risk, interest rate risk, right? So I have a lengthy example for easy understanding of this. Here I just read out, and you also can read once I give the handout, right? Understanding the maturity gap. A bank is exposed to liquidity risk. That is uh, the risk that it will have inadequate cash meeting its funding requirements. So we already discussed what is a liquidity risk. Simply the amount of cash balance required to run day-to-day businesses in the bank. Liquidity risk. If such a bank does not have enough money in their hand to run the business on daily basis, it faces a liquidity risk. To ensure that it has an adequate level of cash for its operations, in terms of maturity of its assets and liabilities must be mentioned. If the gap between the value of maturing assets and liabilities held is very large, the bank may force to seek relatively expensive money at call borrowing. So simply, the matching concept. Matching concept mean what? The long-term loans should be financed by the long-term deposits, long-term financing sources, and short-term financing requirement, short-term capital requirement, short-term investment requirement is should finance by short-term liabilities. It's a matching concept, right? Match. So before exploring maturity gap analysis, if the match is not appropriate, then the company may run out of cash. Sometimes it may have excess money or sometimes deficit of money. So before exploring the maturity gap analysis, we must first review how banks operate, which is slightly different than most corporations. Assets for banks includes a loan. No? When you look at the balance sheet of banks, you may find a loan, right? Loan to its customers, so which is counter counterintuitive since we think of loan as debt, right? So however, for a bank, a loan is a stream of income in the form of principal and interest payment from the borrower. So banks give loan to its customers for the purpose of generating stream of cash. That stream of cash include both a principal amount plus interest income. Liabilities, on other hand, include deposits, customers' deposits, which again, for an individual investor, would be an asset. However, a bank pays depositors interest on those funds, which is considered as an expense. Of course, the deposits are important because those funds are used to make loan to the bank's customers. So the bank utilizes the customer's deposit to make profit to convert its assets as a loan. So if interest rate rises very important here. So if interest rate rises, bank might earn more income from their loan. It's obvious, but they also have to pay higher interest rate on deposits, both way. Maturity gap analysis helps to address the difference between money due, money payable to its customers, depositors, and the income expected to receive as a loan over the various time frame. So we look at an example, right? Maturity gap analysis, not here. Right. This is the example. Before that, we will understand the operation of the bank. The maturity date of each assets or liability defines an interval, right? Interval mean what? A period, interval, or a band of dates that must be assessed. The interval is a range of future dates, for example, 30 days. In case of loan, 30 days loan, 3-month loan, 32, 1 month to 3-month loan from now. The maturity gap for the interval can be found by adding up the value of all assets and liabilities that will either reach their maturity and need to be refinanced or roll over, fixed, or repriced floating rate. So when you look at uh, the loan as well as deposit, there are two different types. Fixed, some loans are fixed, interest rates are fixed for a long period most commonly, and the short-term loans are very sensitive to its interest rate. Likewise, it's up, the same principle applies on liability sides, deposits. To understand the gap, assets and liabilities are grouped according to their maturity, right? Short-term assets and short-term liabilities and short-term assets should be grouped one, and long-term assets and long-term deposits a group another one, like this. To understand the gap, assets and liabilities are grouped according to their maturity or repricing intervals. For example, assets, liabilities due to mature less than 30 days are grouped together, right? Any assets or liabilities that are mature within 30 days, 1 month, is grouped together. Assets and liabilities with the maturity date between 270, 265 days, almost 1 year, are included in the same category. Here, assets mature in 270 days, liabilities are mature in 260 days. So almost equal, so therefore included in the same category, and so on. Longer repricing period have higher sensitivity to interest rate. Longer repricing period have higher sensitivity interest rate changes and are subject to change over the intervening year. An asset or a liability with an interest rate that cannot change more than a year is considered fixed, right? Yeah, an asset or a liability with interest rate that cannot change. The interest rate is cannot change, already fixed by the agreement between bank and the customers. For more than 1 year is considered as fixed. The maturity gap analysis comprises the value of assets that are either mature or repriced within a given time interval to the value of liabilities that either mature or reprice during the same period. Reprice means there is a potential to receive a new interest rate, reinvestment like that. A positive maturity gap, right? The positive maturity gap indicates that the bank holds more rate sensitive assets that the rate sensitive liabilities for that interval. We already discussed in detail with examples too. A negative maturity gap indicates that the banks hold more interest rate sensitive liabilities that will be due during that interval. The size of the gap between the assets and liabilities represents the degree of potential risk or volatility. You know, the gap between the assets and liabilities represents the potential risk and volatility of the value of holding in the event that market interest rate changes between now and then. So here we have example, right? For example of maturity gap analysis, right? Please give more concentration on this, right? It's very important area. I have search and find this question for you. Example, right? For example, the balance sheet for a bank is provided in the table below. Let's calculate the maturity gap and interest rate income and the expenses for the next year if interest increase by 2%. So now we are going to analyze the interest rate risk due to the changes in interest rate. Now in this example, so there will be a change for the next year if the interest rate increase by 2%. So this is the existing year. Here assets, and the total assets, total assets equal 25. So floating rate loan. So in floating rate mean what? Uh, Floating rate mean fluctuates, variable interest rate. And 20 years fixed rate loan. So which one is more sensitive? Floating rate or fixed rate loan? Which one? My dear students, which one is rate sensitive loan? The first one or second one? 10 million or 15 million? Which one is more rate sensitive asset? 10 million or 50 million? Yes, 2 million is a negative gap. 2 million negative gap. Here rate sensitive asset is 10 million and rate sensitive liabilities 12 million. 10 minus 12 equal 2 million is negative. So gap is negative. So I move to the next slide. For the calculation, this understanding, basic understanding is very important. Otherwise, you can't move. So using this, the figure in the table, the company's maturity gap for the next 365 days for the next 1 year is interest rate sensitive asset minus interest rate sensitive liabilities, that is 2 million minus 2 million, that is negative, because the bank loan has more, the bank has more interest rate sensitive liabilities, right? More sensitive liabilities because 12 million. Then assets in this band, in this band mean within 1 year, the maturity gap is negative. This means that the rise in interest rate is expected to lead decrease in the net interest income over this period. Here, so here the gap is negative. It means increases in the interest rate, increases in the interest rate will cause increase in interest rate sensitive liabilities. So the negative gap means when increase in interest rate, it causes increases in interest expenses that will lead to decreases in the net interest income, decreases in net interest income over the period, because here there are, so there will be high cost, there will be high cost on these liabilities. So expected net interest income in millions at end of the year, right? Before changing in the interest rate, before changing the interest rate. So in the example, they give us 2% increase in interest rate, right? And we have to find the changes before increase in 2% interest rate. Now we look at the current situation. Interest income, expected net interest income in million at the end of the year is, here net interest income minus net interest expenses for liabilities. Now we'll calculate, right? Here 10%, here 10%, at what's the interest rate? It's 8% interest rate. And for this 15 million, interest rate is 6%. The liabilities for the deposits should pay 5% interest rate. For the long term deposit, bank should pay 5%. Now, so based on this figure, here 10 million is the short term rate assets, rate sensitive assets, 8%, plus 15%, 15 million is a long term asset loan. So that is 6%. So total, how much? Interest income. Here 0.8 million, here 0.9 million for this value. And 12 million, the rate sensitive deposits at 5%. 8 million is a long term asset, long term liability deposits. Fixed deposit 5 million. So total here 0.6, 0.4. So therefore, so total interest income is 1.7 million and interest expenditure 1 million US dollar. So therefore, expected net interest income is 700 million, 700,000, 0.7 million at this situation. Now we'll move what the consequences of increases in interest rate. So as we explained earlier, so in during the period of negative gap, increases in interest rate will cause higher interest rate that may lead to a lower decreases in net interest income. So let us check, let us test whether is it true or not. Right, maturity gap after the change in interest rate. If interest rate increases, let's see how the change will affect the company's expected net interest income during the maturity gap analysis. So multiply the market values by changes in 2%. bearing in mind that the rate sensitive or floating assets and liabilities will be affected by the change in interest. When you look at here, so there is no effect. So increases in 2% to increase 2% interest rate will impact only on the rate sensitive assets and liabilities, not on fixed loan or fixed deposits. So it will impact on this 10 million and this 12 million. Here assets, floating rate loan is 10%. Now it increases as 2%. So therefore, how much? 10%. Earlier it was 8%. Now it's a 10%. Now how much? 1 million assets. Right? Revenue increases totally, but total revenue will be total revenue on rate sensitive assets is 1 million. Fixed loan, there's no change. Why? That it is not sensitive to changes in exchange rate, interest rate. So therefore, it be like earlier one, 6%. So 15 to 6% is 9. So total interest income here 1 million, here 0.9 million, total 1.9 million. Earlier it was 1.7 million. So also increases how much? 1.9 million. 1.7 million increases as 1.9 million. Right? So 1 million plus 0.99 million. So when we look at the liabilities, so current liabilities deposit how much? 12%. Earlier it was 5%. Now it is increased by 2%, total 7%. Now interest expense increases 0.84. Earlier it was 0.6. 0.6. Now it's become 0.84. And fixed term deposit 8%, 8 million into 5%. There's no change on long term deposits, so there's no change in interest rate. So a total expenses, interest expenses, how much? 0.84 plus 0.4 is equal 1.24 million. So calculate net interest income by adding the resultant values together. How much net interest income? 1 million plus 0.9 million minus 84 million minus 0.4 million. Then equal how much? 0.66. Now due to the changes in interest rate, increases in interest rate, now the net interest income is 6.6, sorry, 660,000, 660,000, but earlier net interest income was 700. Now it has 660. So it's very clear that during the negative gap, then changes in interest rate, increases in interest rate will decrease the interest income, net interest income. Right. I will go a little fast. I hope all of you got understood the thing. If you have any questions, you can ask, right? You can stop me at any time and you can ask. If interest rate increase by 2%, the expected interest rate income decrease by 40, because earlier it was 700, now it is 660. So the change is 40 million down, right? Although a bank typically earn more interest, more income from loan with an increase in overall interest rate. The bank, for example, so its net interest income declined. The reason for the decrease was that the bank had a large amount of, non-fixed rate deposits. It's mean what? So it has a higher rate sensitive liabilities, 12 million, then variable rate loan, rate sensitive asset is 10 million. It's been negative gap. In other words, the cost of deposit rose by more than the interest, the increase in income from a variable rate loan. Conversely, if interest rate declined by 2%, what will happen? In the early example, it was increases by 2%. Now we assume the same situation, the interest rate is reduced 2%. Without doing calculation, we can say that net interest income will increase. Net interest income will increase. The net interest income will increase by 40,000. Earlier it was down, loss 40,000, reduction in 40,000. Now increase in 40,000. So 40,000, because earlier it was 700,000 here. Now this 40,000 will increase. So therefore new income in net interest income will be 740. The reason for this rise in income, despite the lower rate, is due to the bank having more fixed rate loan. Bank has more long-term fixed assets, so than variable rate deposits. In the second scenario, the fixed rate loan helped the banks earn a steady interest income despite the lower rate environment. The maturity gap method, while useful, is not as popular as it once was used. One was due to the rise of new technique in recent years. So newer techniques such as assets or liability duration, right? We will discuss in the next slides, in coming slides, duration, assets or liability duration, and value at risk have largely replaced the maturity gap analysis, right? So I hope all of you have understood. Simple maturity or repricing schedules can be used to generate simple indicators of interest rate risk sensitivity of both earnings and economic value to changing interest rate. If the gap is negative, if a negative gap occurs, here rate sensitive asset is less than rate sensitive liabilities, as our example earlier we have discussed. In a given time band, an increase in market interest rate could cause a decline in net interest income. Conversely, in opposite, a positive gap, rate sensitive asset is higher than a rate sensitive low, so rate sensitive liabilities, it's a positive gap. In a given time band, a decrease in market interest rate could cause a decline in net interest income, right? Here interest rate increases, here interest rate decreases. So that time the net interest income will decrease. The basic weakness with this model is that this method takes into account only book value of assets and liabilities and hence ignores their market value. So this is a summary. So the negative, if the bank's gap is negative and in case interest rate are expected to increase, so there will be a decrease in net interest income. So therefore the bank should consider hedging. Hedging means the bank should looking for risk management techniques, interest rate risk management technique, hedging. So in case of decrease in interest rate, remain unhedged, means no need to for any risk management techniques. So if the gap is positive, when interest rate increases, so no need to do anything, remain unhedged. So in case of positive gap, so if interest rate is decreases, consider hedging. Now the bank will be end up with loss net interest income, right? So therefore consider hedging. They have to make arrangements to hedge that kind of risk. And the next, right, we'll discuss the duration analysis. Duration, the period, in simple term we call it as uh, average period, average maturity, duration, the time period, right? So we make it, so there are when we look at the portfolio of assets of a bank, So it consists of different types of assets with different types of different period of maturities. So by giving some sort of weights, we uh, give a single duration, single period of maturity to that assets portfolio of assets. The same principle will apply to the liabilities too. It basically refers to the average life of the assets or the liability. It is a weighted average time to maturity of all the present value of cash flows. The larger the value of the duration, the more sensitive is the price of the asset or liability to changes in interest rate. So when you look at the maturity is high, then you can predict that it has more sensitive to the interest rate changes in the market. As per the equation, the bank will immunized from interest rate risk if the duration gap between assets and liabilities is zero. So the bank will be at optimum position where the duration of assets and duration of liabilities are equal. So look at this example, the formula. So duration equal the summation, the total of present value of cash flows, right? And the time, the period T, the number of time periods over market price of bond. So this is here PVCFT, present value of coupon at period T, into time to cash flow in years, how many years left, and number of period to maturity. Here is N. So start from 1 year 1 to nth year 1, 2, 3, 4, like that. So we have to calculate these things. Why weighted, why market price of the bond. So duration can capture the different degree of interest rate sensitivity, right? So each and every asset has its different time maturity period and different interest rate. So duration equals summation of cash coupon rate, interest rate for a period up to T period. So it's a cost, right? So to convert present value, to convert this cash flow into present value, we have to divide 1 plus K, cost of interest, cost of debt. Here the same thing, it's a value, right? Market value, to find the market value. So we put this, and here it's to convert this cash flow uh, to the present value, we use this. The duration of the bank's assets portfolio is the weighted average of duration of individual assets. The bank can also estimate the duration of its liability portfolio and then estimate the duration gap, right? So the same principle can apply to liabilities also. So duration gap, how to find duration gap? It is not simply a duration of assets minus duration of assets, not like that. It's a little different. So duration gap equal duration of the assets, duration of assets. A is mean assets minus, in the bracket we put duration of liability into liability over total assets. Liability, the ratio between liabilities and total assets. So this duration of liability will be weighted by their assets. Here a duration gap of 0 means that the bank is not exposed to interest rate risk. Not exposed to interest rate risk. So banks with positive duration gap, it means the duration of asset is higher than this part, rest of the liabilities side. So bank with positive duration gap are adversely affected, right? Adversely affected, badly affected by raising interest rate and favorably affected by declining interest rate. So if the duration gap is positive when interest rate is increases, then the bank will be affected, badly, adversely affected. But if the gap is negative, the bank will favorably affect it, right? Assets with shorter maturities have shorter durations. Assets that generate more frequent coupon payments uh, every month or every week or shorter than that. Assets that generate more frequent coupon payment have shorter durations. The capabilities of durations are limited when applied to assets that can be terminated on moment's notice. So here we let us have an example. Please look at this example for a while. A duration gap is not a difference between duration of assets minus duration of assets. It has a different way, little bit different way, right? So duration of the asset equal 4. We take this value here, and to find the duration of liabilities, we have to make some small adjustments. First, we take this one, this taken from here, total liabilities 2.33, and 0.9. How do we get here? Duration of liability into liability over total assets. Here, liabilities here, how much? 900. Total assets is 100, also 1000. So 900 over 1000 equals 0.9 into this value. So duration is 1.90. So here the duration is high. Duration of assets is higher than the duration of liabilities. Therefore, it will volatile to high interest rate risk. Here it's a summary. If the bank's duration is gap is positive, as with this example, here is positive duration gap, when interest rate increases, here consider hedging. It means it will impact on net interest income. It will adversely impact on net interest income. So in case of decrease in interest rate, so remain unhedged, no need to for hedge. In when the duration gap is negative, when interest rate increases, no need to go for any hedging. So in case of a decrease in interest rate at the negative gap, consider hedging, right? This is the summary. The third model is method is what? Regression analysis. So it's very simple and very straightforward. Here, right, you, if this is a R is what? A regression estimation. Here B node is the what called intercept, and B1 is the beta coefficient. RM is the bank performance. Here beta coefficient of interest rate changes, and U is the error term. A bank can assess interest rate risk by determining how performance has historically been influenced by interest rate movement. A proxy must be chosen for bank performance. This is what? Bank performance. And for prevailing interest rate, this one. And regression analysis can be done, can be applied this here, right? A positive coefficient suggests performance is favorably affected by rising interest rate. So based on the beta coefficient of here, you can assess the interest rate risk. If interest rate coefficient is 0, the bank's stock returns are insulted from interest rate movement. If the beta here B2 is 0, then so there is no impact of interest rate. The vast majority of research has found that the bank stock level are inversely related to interest rate movement. So regression analysis can be combined with the value at risk. Right, earlier we have discussed value at risk method to determine how its market value would change in response to specific interest rate movement. So we can do some highly statistical technique to tackle to find the value at risk. So if you are interested, I can give you one YouTube link where you can find, you can you can understand VAR in detail. So if you have idea on research, if you have any idea to find this value VAR, value at risk, in your final year project, so it's very interesting, right? So in the regression analysis, in case of negative coefficients, if the coefficient is, if the bank's interest rate coefficient is beta 2, it's negative, in changes in increase rate, consider hedging, right? And decrease the interest rate, remain unchanged. Like if the regression coefficient of interest rate is positive, then regression, sorry, the increase in the interest rate will remain unhedged, but decrease in interest rate will consider hedging. So method used to reduce interest rate. So this is what, let's take time, right?